Good afternoon, viewers. I welcome you to the fourth episode of IFA-India Academy's monthly webcast on international tax and transfer pricing updates. Like all our previous episodes, I have two distinguished panelists with me here, and which I will introduce without any further delay. In front of me is Ganesh Raj. Ganesh Raj is a senior tax partner from Ernst Young, and Ganesh specializes in tax policy and international tax matters. Am I right, Ganesh?
Yes, that's
Yeah. To my right is Rahul Mitra. Rahul Mitra is in KPMG and he heads the BEPS and the dispute resolution uh, part of KPMG tax division. So Rahul, what do you exactly look after in these two fields?
Well, as you know, with the BEPS coming in, that's a big focus area for any firm. So I'm basically focusing on that, and also my core area of specialization has been dispute resolution and APAs on transfer pricing, also international taxes. So that's what I'm basically focusing on.
So we have a specific topic of an APA. So welcome here. And without further ado, we will start. We are in February. February is the month where everyone looks with anticipation. The budget is cooking somewhere. Yesterday, the traditional halwa was made, which kicks off the printing of the budget booklet. So I fear no part of our discussion would actually impact the finance bill now, but still no tax discussion in this current month is complete unless we really do some crystal ball gazing on what this budget holds for us. So Rahul, starting with you, do you anticipate, and you mentioned BEPS, that do you anticipate any part of BEPS to feature in this current year's finance bill?
Well, I would say, Amitabh, I think the most likely introduction of some of the BEPS recommendations would be the master file and the country-by-country reporting. And this is something which the Indian government has been pretty vocal about, in line with its participation in the G20 initiatives, which had actually fathered the BEPS along with OECD. We certainly expect master file and the country-by-country reporting to be incorporated in the current year's budget.
So Ganesh, do you feel that country-by-country reporting is going to become a reality?
Yes, I think this is one of the key features of the BEPS report is that the first time all the G20 nations have come out with a tax report, which is by consensus. And there are certain features of each of the action items which is mandatory for the countries to apply, depending on the cycle of the fiscal year where they are. And I think one of the key things which I would agree is that the government is very clear to bring in this budget the country-by-country reporting.
And is country-by-country reporting coming in other countries also?
Oh yes, many countries, most of the developed countries, US, UK, Australia, Germany, they've all introduced, have already introduced the country-by-country reporting and master file. You see, Amitabh, when we talk about country-by-country report, we shouldn't be, I would say, oblivious of the fact that country-by-country report is only the offshoot of the master file. So the more important document is the master file.
Right.
And the country-by-country report is just a manifestation of what you put in the master file.
That's right.
So both together, combined, form the actual, I would say, the impact or the legislative change that we're looking at.
So states are already bringing it into their domestic legislation.
They have already been introduced.
So that's a good start. And do you think that is going to create an immediate kind of impact on how companies do business, or the government, do you think, will give some time? My question to Ganesh first to adjust to it.
Yeah, I think that, as far as India is concerned, it is predominantly going to impact the India headquarters company, who have a significant outbound presence. So what it needs is that once the budget announcement is made, and the BEPS report also gives the template of the master file, which Rahul mentioned, and as well as the country-by-country reporting. Too many data and informations which are required, which either the tax authorities did not have the advantage to use it. And so the Indian headquarters company immediately, based on the announcement, have to revisit their structures, revisit their transfer pricing policies, And based on that, they have to be very clear that there has to be consistent information which is to be given as part of the country by country, because each of the country will have an access wherever this jurisdiction has its presence. So the no more issue of dilly-dallying of different facts in different jurisdiction, we have an advantage to that.
So in terms of your own clients, have you been advising clients proactively on this, or everyone is waiting for something to come before they start action?
First of all, I couldn't agree more with what Ganesh mentioned. It's predominantly going to impact Indian headquarter companies as they're going outbound. You see, many of our clients, depending upon the degree of preparedness that they are in or they would like to be in, there are several companies who have already started this diagnostic approach. You see, one is carrying out or creating a master file documentation or a country-by-country tabulated report once the year is over. Mind you, the year is going to start from 1st April 2016. So as Ganesh mentioned, unless you're able to have a deep dive and a diagnostic review of your current operational structure, your global supply chain model, and you're able to take the corrective measures to put things in place, merely carrying out a compliance after 1 year will not actually suit serve the purpose. So many of the companies have already been involved in the process of this diagnostic review and I would say taking the corrective measures to set the global supply chain in place.
So it will change the whole attitude towards transfer pricing.
I would say, for the better.
For the better. So instead of being retroactive or reactive, it will be a lot of planning and thought put in before you enter into a transaction. So you mentioned about Indian headquartered companies. That brings me to the next point, which is place of effective management, which I guess is another thing which will impact primarily Indian headquartered companies. The draft guidelines came in very late. It's not been finalized as yet. Do you see, a fair case for its deferment?
Yes, I think the draft guidelines, Amitabh, what you said is correct, came somewhere in December, and they extended the deadline for the public comments up to January 9th. And we are virtually on the end of this fiscal year, although the law was introduced from April 15. I think there are all representation which has gone from institute and industries, body and all. I think there is a very likelihood that they will defer it by 1 year. More importantly, I guess that it is adding to one more compliance in that sense and bit of uncertainty, because if you summarize the total poem, it was creating some of the issues, particularly for regional headquarter company structures. It was also creating somewhere some preponement of the revenues in some situations and all those things. So I think there is every likelihood, in short, that they will defer it by 1 year.
Okay. So Rahul, a question here. Do you see any, harmonious way of, BEPS and POEM? Do you really need something like place of effective management if you really, are keen on implementing base erosion and profit shifting in its spirit?
Well, I would say, see, POEM is also an offshoot of BEPS. I'll explain why. You see, one of the recommendations of BEPS was the CFC guidelines.
Right.
And India is part of the direct tax code, which never saw the light of the day. Though several recommendations of the DTC have since been incorporated in the Income Tax Act. One of the BEPS recommendations have been CFC, the Control Foreign Company Rules, where you park passive income outside. Now, India, as part of the POEM guidelines, have brought in these concept of passive income, the active business test, in the guidelines of POEM, which is a little unique because we have seen that not many countries across the world, wherever they have this concept of POEM for deciding the tax residency, they actually have incorporated what you call the passive income as part of POEM. So one way to look at it, if you wanted to have CFC separately and POEM separately, it's a different thing. But I would say having POEM in this manner is actually nothing but
CFC
also putting in CFC in a disguise, in a surrogate manner as part of POEM.
Right. So in a way, probably a CFC rule would have done a better.
It would have been better because it would have been less draconian. First of all, the way the CFC rules were, listed companies outside the country, they were exempt from a CFC. Also, when you are talking about CFC, you're restricting the taxability only to the passive income.
That's right.
Now in POEM, the moment your passive income is more than 50%, your entire 100% income is susceptible to tax.
Everything.
So probably CFC in a more refined way could have been better than POEM, or POEM could be, as Ganesh also mentioned, as POEM could be better moderated to bring in line with the international best practices. But one thing I certainly agree with Ganesh, I think it's only fair with the year virtually in its 11th month that POEM should be deferred.
It should be deferred. Is that what you feel?
Yeah.
And what about CFC? Do you think the government should bring in CFC rules? I recall 2 years ago there was some talk, and the entire India Inc. rose up in arms. I rarely see such solidarity.
Yeah. So this came, as Rahul was mentioning, as a part of the DTC,
Direct tax code. Yeah.
And I think the debate at that point, from a policy perspective, that do we have enough outbound investments for us to introduce this, number one. And number two, the question was, is it a revenue gaining exercise or is it share in anti-avoidance measure? And I think what he rightly summarized, that there is a connect between CFC and POEM to the extent that POEM has been stated very clearly is an anti-avoidance measure. It's not a revenue gaining measure. So I don't think so. By bringing in POEM, there is no need for one of the action items of the BEPS report, which is on the CFC. They will not get into that. And B, also probably even in POEM, they may reflect that whether it's a right time, same like CFC, that should we bring in, and if so, we bring in what sort of safeguards and measures and other things have to be given.
So let's wait and watch. And before we move on to the next topic, just one quick, what is your topmost wish list, for this budget in your area of work?
I would say, I think when we're discussing today, it's on transfer pricing, international taxation.
Right. That's right.
I think the first, we can talk about some of the recommendations of the Justice Easwar Committee for simplification of taxation rules. I think one would certainly be, where we have this provision that unless a foreign company submits its PAN, it's subject to what you call a higher rate of withholding.
That's right.
So one of the recommendations have been that, okay, you see, getting a PAN in India is a cumbersome exercise. So why don't you, have the procedure simplified? Just because if he's able to, let's say, submit some tax identification number, some unique number. So one has to be, one need not have to go to the rigmaroles of getting a PAN. So I think that's one of the recommendations. It'd be good if the government. So
you see that as a clear irritant in this whole ease of doing business.
Absolutely, it's a simplification,
right?
Because one of the what the committee has said, that is actually discouraging foreign companies from doing trade.
Okay, that's very valid. So I think that ties in with our next part of agenda, which is Justice Easwar's committee's first report, I would say, or first draft report, where a lot of recommendations have been given on simplifications. So which are the key elements which strike you as noteworthy?
I think the basic background in which, if you see those 30 odd recommendations which have been given, it falls under the two umbrellas. One is either of reducing litigations because of the interpretation, or it is ease of doing business. I think one of the best thing which I liked, it's very difficult to pick one or two, but broadly if I see that first is this dispute always between this capital gain versus business income. That is
FIIs also.
FIIs and all, more than 12 months, if you have an unlisted stock, then it has to be treated as a capital gain. If it is less than 12 months, even if it is less than 5 lakh capital gain, still it has to be treated as a capital gain. I think this issue we have been going through for the past so many years. There have been a number of recommendations, including within the board, in either way. So that's one of the top one. And second, you come to some of the procedural things which are coming. Take very simple example that there is a new issue which they started, that if there is a refund due and your notice issued 143.2, refunds will be detained and it will not be given. And in fact, recently there have been few writ petitions filed in the Delhi High Court, where the court has allowed, saying that you cannot withhold just because the issuance of 143.2 or not. Similarly, the TDS provision which Rahul mentioned, 206AA, of the lack of PAN, higher rate, or there is a payer has deducted wrongly or wrong mentioning of TAN, the payee is unable to claim credit of it. So I think there is a recommendation to that effect, saying that the payee can file in the prescribed format and just go ahead. So there are several such procedural, TDS related, capital gains related, and also the last, my favorite is, of course, they have recommended two things. One, there should not be any prosecution on the delay of deposit of TDS if it is deposited by 12 months. And because last year we found that there are a few cases where there was a one-day delay, there was a show cause issued for prosecution.
So are prosecutions being launched? I thought this was just a provision in the statute books, never taken.
No, last year there was a number of such cases in the TDS delay of deposit.
So they just take the tax audit report and issue show cause. Okay.
They didn't proceed with it, but the fact remains there was show cause notice. I think that's a very good welcome step. And the last one is, of course, the ICDS. It's more on the lines of poem. It was not publicized, number one. And when so many compliances coming on the way, like AS, ICDS, poem, and everything, I think it was just adding one compliance. And B, it was neither revenue was gaining anything from it, because it's a timing issue. Either you are preponing the revenue from a government side or postponing it. And it would have a detrimental impact on some of the very sluggish corporate profit, the way what we are seeing, at least for the last year.
So what's your personal view on ICDS? Do you think it should be totally junked, or there should be a time given to the industry to come to terms with it?
You see, I personally feel that industry should be given time to breathe it. With so many things coming up, it'll be just adding another compliance burden on the industry. I feel ICDS may not be required because you now have Indies, which is I would say pretty robust accounting standard. We have the concepts of accrual, what's income, deferral, etc., which have been well settled by Supreme Courts, High Courts for the last 60 years or so. So I don't think we really need an ICDS for talking about as to when income should arise, when the expenditure, when the liability has been incurred, etc. I think it's pretty much it's very well understood by virtue of these court decisions. So I personally feel ICDS as such is not required. In fact, that's what Justice Easwar's committee's recommendation also has been, that first of all, whether ICDS is at all required, and in any way to defer it. I think what he talked about was not just deferral by a year, to defer it unless the government actually takes stock to understand as to whether it is actually needed. So I certainly echo what Ganesh mentioned. ICDS I don't think is required, and in any event, a lot of deep thinking needs to be done before implementing it.
One more thing in the report which struck me based on my past experience is this whole thing about issuing show cause or reassessment proceedings merely on the basis of audit objections. Do you think that has touched a very relevant and sore point?
I think, talking from an international tax perspective, in 9 out of 10 cases, the reopening used to happen only based on the audit objection.
9 out of 10
9
cases?
out of 10 cases, because either you have applied a wrong rate under the treaty, or you have characterized the income in a different manner, or you are supposed to have a P and you have not filed your return as P, and all those things. And most of these will used to be audit objection as a revenue loss, or having missed proper application and enforcement of the provisions. And if you sort of travel the journey after the post issuance of the 148, it will get struck down invariably at the tribunal level. Not on the technical grounds of 148, but the mere fact that there are two interpretations possible, there is no revenue loss involved. I think that's a very good welcome suggestion which they have made in the Justice Easwar committee. At least all those 148 will be very sort of merit-based, and it will not be a very based on the audit objection which is given. Because the understanding of some of the international tax provision for the auditors who makes this insinuation is also sometimes very under question.
But I feel for the tax officer. The CAG has made an audit objection. Now I am in a dilemma. What do I do? If I don't issue a show cause, is my own integrity put to test?
I think, Amita, what the whole idea is that you should be issuing a show cause just because there's an audit objection.
Right.
There has to be a proper objective satisfaction of the deed to issue a show cause for either a 263 or a 147, as the case may be.
Mm-hmm.
I think that's what the recommendation is, that just don't shoot the show cause. I would say
as a
mechanical exercise.
Right.
Take an involved decision yourself based upon objective satisfaction and then issue it, which could be fed by an audit objection, but not driven by an audit objection. I think there are two more other points on the Easwar committee, and I know we have other things to cover as well.
Right. Please mention.
But I just like to mention one was there was a Supreme Court ruling of Goetz. Whether it was intended in that particular manner or whatever, but the fallout of that was that once the time for filing a revised return was gone, you could not file any further or make any fresh claim for reduction or exemption of any expenditure or income.
Right.
It was certainly putting taxpayers in a lot of I would say disadvantage. Again, there were other Supreme Court rulings that you can go and make a fresh claim before a tribunal. If you can go and make a fresh claim before the tribunal, then why not for those last remaining few months before the ISing officer?
Right.
Now, this committee has again made the recommendation that yes, you can do it. Either within 30, I think it was 30 months from the end of the fiscal year, or with a condition of the assessment. I think that's a very, very important point, which is going to obviate a lot of discomfort and disadvantage of taxpayers.
Right.
And the other recommendation is that when you are talking about Section 14A, the exempt income, they're saying that dividend, though it is legally an exempt in the hands of the shareholders, but from an economic standpoint, it has suffered tax as a DDT.
As a DDT. Yeah.
So I think it's a very, very pragmatic recommendation that if you have dividend, which is suffered DDT, it is not an exempt income. So therefore, expenditure incurred with respect to dividend earning, that should not be disallowed. I think these two really stand out in terms of recommendations of this committee.
Do you agree with that, Ganesh?
In fact, perfect. In fact, it's adding just to what Rahul just said. Under the 14A, they have also made one recommendation saying that any interest on the borrowed funds used for earning a non-exempt income, there used to be a practice that used to be clubbed under this 14A, and those interests used also to be disallowed.
Right.
I mean, in some cases, they used to arrive some proportionate, but wherever there's a difficulty, practically, they used to simply disallow. So that is also a recommendation which is made that for such non-exempt income, for the borrowed loans, interest should not be disallowed. And I think in some debate, I heard that much of the litigation on this 14A was flowing because of those 2-3 issues.
No, I read a lot. I think every 2 out of 5 cases which come up or resolved at the tribunal are relating to 14A cases. So I sincerely hope that in this budget, although it's just a draft recommendation, if some of these are sort of suo voto accepted and some simplifications passed. So moving along to our favorite topic of the day, which is dispute resolution. Both of you have had ample experience in resolving disputes. And I think one must go back to the start of dispute resolution, which started with the authority of advance ruling, which was set ages ago. Coming back, followed later. There was a huge time period before then the DRP came up, and the MAP has always existed in the treaty and hence the statute all these days, and then APA came as a breath of fresh air. So now a typical multinational taxpayer has a lot of these options or avenues to resolve these disputes. So a lot of ground, Ganesh, my first question to you, has been covered over the last 15 years. So how do you see, how has this landscape evolved, and what do you feel good about it, and what do you feel should are something areas where we have not performed to your expectations?
Since we are restricting this whole discussion to 2 areas, one is international tax and the transfer price. If you see that there was a stage maybe a few years back when pretty much we had cases of mutual agreement procedures which were non-TP related because India did not have a TP regulation. So mostly the issue was on characterization, permanent establishment, attribution, and all those things. I think slowly and steadily, of course, we didn't have number of cases, so it was going on. And then came sort of a DRP, and the whole purpose of the DRP essentially was so that there is a double check before the assessing officer gives a draft order. I think the initial, and it was also evolved over a period of time. Initial first few years was not a great experience from either side, I said. And gradually, as it improved, yes, there were some trends saying that they could recognize, they understand the fact that yes, it is supposed to be dispute resolution, not sort of endorsing what the AO has done. Now, coming to APA and MAP, post this APA was set up. So broadly today we are standing in a statistics of around 200 odd cases which are pending in MAP. And this is of the various jurisdictions including US, UK, Japan, and some of the other European countries. Of that, 70 to 80%, of course, these details are not known because India does not publish this outstanding statistics, which is what was one of the recommendations of the OECD and the BEPS also. But roughly 60 to 70% of them are related to transfer pricing. When during 2011 to 2014, the spate of the transfer pricing adjustment started, obviously most of the people resorted to MAP cases. Of that, the largest chunk was to the particular geography, which was US. I think what they did right is that once they prepared a framework agreement between US, instead of going individual cases, and broadly agreed the framework, under the framework, what sort of activity and based on that, what ranges we will talk. And once there was an agreement between both the competent authorities, it was easy to push the bulk of the cases in each of this category. And at the last statistics which was published in the press, it said that around 100 cases we have solved. So I think it is quite possible the way they actually went about the process. And I guess going forward, if you were to ask me, the framework agreement still stands, not that all is over. There are some other countries where it is still outstanding. So I think taking the cue from that, they will only proceed with that. Coming to APA, of course, Rahul will have a better thing, but my little understanding is, since the time we opened up APA, today roughly 500 plus cases are pending in APA, have been filed for APA. Both unilateral or rather predominantly unilateral and bit of bilateral. Of that, around 41 cases have been cleared as we speak 2 weeks back. 2 of them are BAPA and the rest are all unilateral. I think there also the thing is that they pretty much mirrored it based on the rulings or the settlement which is happening for TP cases under MAP, so that there is no disconnect between unilateral position as well as the MAP cases. So I think going forward, I just see that probably the basic hard work which have been put by all the AP offices, directorate, is very much in place. It's now momentum will pick up. And I think if you look at internationally also, whether a unilateral or a bilateral, minimum it takes minimum 2 to 3 years. I think, well, we are very much within that range only now. With 41 cases at the end of the second year of filing, I think we are pretty much there now.
So 41 out of approximately 500 cases is hardly just not even 10%, and APA seems to be the flavor of the day. What is your prognosis on its efficacy?
Well, look, Amita, when you say 41 out of 500, I don't think that's a fair comparison because 500 have been filed so far.
Right.
So I think what you can say is 41. Let's talk about the first 2 rounds. Okay,
right.
The first 2 rounds. First round was March 2013. Second round was March 2014.
Right.
In those 2 years together, there were about 370 odd cases. 41 have been signed.
Okay.
As Ganesh mentioned, it took a little bit of a time to sign those 41. Keeping in mind that most of these APAs related to IT-ITS, routine IT-ITS, where you're talking about just a number, okay, not the complex ones. So I'm slightly disappointed at the pace in which it has moved. Probably one of the reasons was that, as you are aware, the India-US bilateral corridor was closed.
Right.
It just opened on 16th February 2016.
Okay.
Yes, just about some days back, last week. Now, with US being the largest trade partner of India, now obviously India could not do something unilaterally, which would have impacted, the US on the other side, because I think 70% of the trade is with US. So once India started to negotiate and finalize the map cases of US, though they were for earlier years, now the APA resolutions are more or less in line with the map cases. So now I think the momentum is certainly going to pick up, and more of these unilateral APAs either will be signed, or some, depending upon the risk appetite of the companies, some might like to convert them into bilateral, again from a US standpoint. But I'm more curious, as to the manner in which the Indian government are going to resolve the complex APAs, not the cost plus ones. The complex ones, I would say involving royalties and marketing intangibles, etc. That's where the real test of the I would say the APA team would come in. And while on the APA ones, certainly I would say a recommendation and a suggestion that, you see, I think when you talk about the efficacy of the APA, there's no doubt that the bilateral APA is much more efficient than the unilateral APA, because there you're negotiating between two sovereign countries without fetters being put on, let's say, on a tax administration of a particular country. There are at least about four trade partners that India has, and because the treaties do not have an Article 9.2, the corresponding adjustment, the Indian government has taken a very unique stand that absent a 9.2, India will not entertain a bilateral APA or a bilateral map. So this is something there's no doubt that India needs to change, because like Germany, Singapore, France, these are two important trade partners that you cannot negotiate bilateral APAs or maps with. Korea. So Korea, I think they are talking about revising it. So even without revising a treaty, it takes a lot of time to revise a treaty. But India must change the stand of, I would say, staying away from negotiating bilateral APAs and maps, particularly bilateral APAs, if Article 9.2 is not there. The other countries in the world don't take such a rigid stand.
So just for further clarification, our Act and the rules provide for bilateral APAs. So what's holding back?
You see, it's not the Act and rules. Now, in the tax treaties, when you have an article of transfer pricing, that's Article 9.
Right.
Now, there is a provision of corresponding adjustment. That if there is a adjustment, if there's a transfer pricing adjustment made by a country, then the other country, based upon map resolutions, can give a corresponding adjustment for the transfer pricing disallowance which have been made.
Right.
Now, India's stand is, now one is, let's talk about the OECD stand. The OECD says that even if you do not have a clause of corresponding adjustment, falling back upon the mutual agreement procedure clause, you can still go ahead and give this necessary adjustment through this map procedure. Now, India has taken a stand that if a particular treaty doesn't have that corresponding adjustment clause, then India will not entertain a bilateral map or an APA. This is India's stand. Now, particularly for APA, then look, map you can still understand that there is an adjustment which has happened first. Then you're talking about a resolution to give a corresponding adjustment. APA is something happening in advance. No adjustment has taken place because you have filed for an application to understand what ramifications going to have going forward. So at least for bilateral APAs, India needs to change this attitude of not admitting bilateral APAs for these important trade countries just because their treaties do not have an Article 9.2.
So these two bilateral agreements that
they are with UK and Japan.
UK and Japan. They're where corresponding adjustment is possible.
Are there.
But the US, which is the major
US also is possible.
US is possible.
It was more at a diplomatic level. The US IRS and was not very keen to resolve with India because India's stand in earlier years. The important countries which are left out are, as I said, as we discussed, Singapore, Germany, Korea, France. These are very important ones.
And what should India do? Just changing its stance is enough?
Just changing the stand.
It doesn't have to do anything with statute book or anything like that. Okay.
Maybe we will see, just to add to what Rahul said, is one of the recommendations in the BEPS, Action 8, 9, 10 related to transfer pricing, and also the last Action 15, which is on the dispute resolution. Probably India may, as a part of the BEPS, may change their stand and say that pending the renegotiation of the treaty, in the absence of a 9.2, still we will encourage APAs to map from these 4 or 5 trade blocks on this issue.
So it's more of having a holistic and a broader view than anything which is preventing us from the statute from that perspective. So let's see if that happens. We are all hopeful. So now moving to some of the case laws or judicial developments which have happened. We are moving from policy to actual on the ground, and I start with in transfer pricing, the most glamorous thing, which is the bright line test. And we've seen slew of cases on that. Started with LG, then Sony Ericsson, and now we have Whirlpool and a couple of others coming in. Rahul, you must have had first-hand experience of A&P expenditure. So if you could, for the purpose of benefit of our viewers, just quickly take us through that, and where are we, in terms of a consumer goods company? Where does the legislation or jurisprudence stand as we speak?
Well, I think I have to summarize it in very shortly.
Very short.
So the question is, I think revenue, to start with, had gone in a little bit of a tangent to deal with the entire issue of A&P expenditure. The revenue was too focused on expenditure and the reimbursement rather than addressing the overall issue of marketing intangible.
Whether an intangible was being created or not.
So ideally, what happens, the view or the approach with the revenue should have taken is to see the characterization of the Indian company. It could be a distributor, it could be a licensed manufacturer. Then see who is the economic owner of that marketing intangible, which are being exploited in India, and whether that the economic owner of the marketing intangible, if it is India, and whether India has got the fair reward for this intangible. If India has got the reward for the marketing intangibles, let's say, which is economically owning by creating it or whatever, then there was no need for the revenue to suggest that you should mandatorily get a reimbursement for the expenditure, because that would have been double taxation. So the important thing is that you have to see as to whether India has got the reward. So let's say for distribution, and we got this very, I would say, very pragmatic and very reasoned ruling of the Delhi High Court in the case of Sony Ericsson. And again, it was more or less in line. I had the privilege of appearing for the BMW ruling to say that, look, you have to see it from a distributor standpoint, that he's carrying out one function of buying and selling goods, and in that process also carrying out several other, I would say, sub-functions. For instance, storing and warehousing, creating a distribution channel, leadership networks, etc. For doing all these functions, if the principal manufacturer gives him a common reward, just one reward, that is fine. And he doesn't need to break the reward, compartmentalize the reward to say, okay, for marketing, I'm going to give you this. For storing, I'm going to give you this. He can get a combined reward. And if he gets a combined reward, which is an arm's length, commensurate to what other distributors are getting, which are comparable distributors, whose functional profile, whose intensity of functions are more or less similar to yours, then don't go for a separate reimbursement adjustment for the so-called A&P. And that's where the High Court ruled in favor and laying down the principle. Now, when it comes to manufacturers, I personally feel the revenue has got it all wrong. Because for manufacturers, what happens, the entire economic activity is happening here. Typically, a licensed manufacturer would import some raw materials from outside and might also pay some technology or brand royalty. So far, licensed manufacturers, for the revenue to say that no, you have incurred so much of expenditure, you should get a reimbursement, was a misnomer. What the revenue needs to see as to whether the Indian licensed manufacturer, who has actually got the profit by manufacturing and selling the product in India, has he actually siphoned away entrepreneurial profits relatable to marketing intangibles to the foreign company in some way or the other. That means the issue would have been a more focused attention needs to be placed on royalties, on the import of raw materials, in trying to test on a transaction by transaction basis as to whether those transactions are arm's length on a standalone basis. Once you do that, the entire issue of excess A&P, lower A&P will go out. But unfortunately, the revenue went a little bit of a tangent without even giving heed to what the characterization is, trying to paint every taxpayer with the same brush. Say that, okay, if your A&P is higher or lower, you should get a reimbursement.
So, Ganesh, some of the recent rulings have actually hit at the very root that this is not a transaction at all and there is no agreement. Is that something which if the revenue authorities could, by a minor tweak in the law, by an amendment or something, again sidestep and raise this whole issue?
Yeah, so two things are there. The latest one, which is the Whirlpool. And there the court has emphatically come out as a twin test. There has to be presence of an agreement. The agreement should very explicitly say that there has to be an overspend on the AMP expenses. And if they say if those two twin conditions are satisfied, then the functions translates into a transaction. And once it is a transaction or not transaction, that will determine whether how to go proceed. So the question is that whether is this a settled law, or how are we likely to see some changes? One, I think the revenue has challenged the Whirlpool judgment in Supreme Court already, number one. Number two is that I don't think so, as in the past we used to see that the revenue is changing the retrospective law because of to ensure or protect the revenue, they will not do. But there is one room available for them to tweak the law, which is in view of the BEPS, the marketing intangibles. Whether they do it now or they will wait for the Supreme Court to give its final say, one has to wait and watch. But I guess there is a room available for them to clarify this 922F5, which deals with such a situation, as to what is their stand now. Because today, if you were to ask a question that what tribunal will do, because there are a number of cases which are pending, and probably at least in the Delhi jurisdiction, Delhi tribunal has two options. Yeah, one, they may come back to the TPO because he has excessively relied on the overspent part of it only. Or the second, they may take a call saying that based on the Whirlpool, if there is a agreement and there is a overspend, it is very clearly demonstrated, then they will not. Otherwise, absence of one of them, they will delete these adjustments. So they may do one of them.
Good. So I guess right now the situation is in favor of the assessee.
I would go a step further. When we talk about licensed manufacturer, again, overspend, underspend, I think it's also for the taxpayers to take the correct stance.
Right.
And we have discussed around this earlier in other forums, that ideally for a licensed manufacturer, the overspend or underspend won't really arise, because typically a licensed manufacturer won't be taken as a tested party. So since he cannot be compared, so his AMP also cannot be compared.
Because his transactions are more complex.
More complex. So it is ideally, since it's a complex entity, then one has to see what the transaction with the foreign entity are.
Right.
Or foreign entities are, foreign related parties are. If they are import of raw materials or components, typically I would say 99 out of 100 times, if someone goes into the deal, they'll be imported on a cost plus from the other side. That means you should take the foreign AEs as the tested party.
Right.
And royalty is something which I always say should be properly examined and tested both by the taxpayer and the revenue. The answer to marketing intangible actually lies in the royalties. That whether you have actually diverted your profits related to marketing intangibles to royalty.
Right.
Do a proper robust CUP analysis. If you have proper third-party license agreements, if you do not have third-party license agreement in the industry in which you're functioning, go for a residual profit split. Now, transfer pricing is not an easy subject. You're in trying to make it legalistic, you're creating more confusion and also trying to make a sophisticated subject easy, and trying to make it easy also it leads to other
erroneous
transfer pricing has to be done in a sophisticated manner, in a specialized manner. So if the revenue and the taxpayer also take the correct stand, I think the issue will be more focused towards marketing intangibles and less towards AMP expenditure per se.
Right.
Now I will just you talked about is there a chance of legislative amendment?
Right.
I would say no. Even if India had Section 92 the way it was before 2001, all these issues could have been discussed, raised, settled without even detailed guidelines. Because the issue is very simple: that are you economically owning the marketing intangible? And if so, have you diverted profits out? So for doing this, you don't need a law. All you need to do is economic analysis and understand.
So the whole BEPS standpoint of linking substance to profits should take care of all this.
Yes.
And as Ganesh also mentioned, you see, when you talk about BEPS recommendations for transfer pricing, action plans 8 to 10, these are not, they are not talking about introducing new provisions in domestic law or tax treaties. These are the fundamental philosophy of transfer pricing, which should have been lived and breathed since the last 2 decades and also going forward. So these are soft regulations which should be properly administered by taxpayers and also revenue authorities.
In letter and spirit, both by the
Absolutely, in
industry
letter and
and
spirit.
the
Correct.
regulators. Yeah.
So, an important thing is with India being also an and significant, I would say, contributor to the G20 initiative. Now, India should also, imbibe all these provisions in its practice, because you cannot selectively pick and choose. So now you select everything what's there in part of the BEPS recommendations, 8 to 10, which also covers important issues around marketing, tangibles, etc., and apply them in proper spirit in your transfer pricing adjustments, or your transfer pricing administrations or audits, etc.
So pick and choose, that's what we should avoid. And another thing where India has been picking and choosing is the whole taxation of software bit. And I'm sure both of you have had ample experience. And while I'm picking just one case of MTech India Private Limited in Delhi High Court, but what's the lay of the land? You have some courts ascribing it as royalty, some saying it is goods, not be taxable. If I have a client today, I don't really know what answer to give. So Ganesh.
So I think there are a number of cases which all came through Karnataka High Court a few years back, which was those Samsung, Sonata, and all these were resellers, most of them. And they gave a judgment saying that it is a royalty.
If you're just importing packages and
That's
selling
right,
them.
on the reseller situation also. And they did not go by the argument of the distinction between a copyrighted product and the right to use of the copyright right. And simpliciter, they also ignored the last and famous judgment which is available on the subject is the TCS from Supreme Court. Of course, that was on the context of the sales tax, general sales tax of Andhra Pradesh. And so they came out, and all those cases have moved to Supreme Court, and it is lined up as a bunch of appeals which is on this subject. So that is where, in terms of the Supreme Court level, those issues are standing. But if you come to the High Court level, there have been a number of cases, including from the Delhi Tribunal, Delhi High Court. One was the latest one, which you just now mentioned, MTech, and earlier it was Infrasoft. All them have consistently held, saying that it is not a royalty, and because it is a purchase or payment is for the copyrighted product. And they have, both the judgments have not actually gone as what OECD is saying or what the US regulation has made the distinction. They said itself within the Copyright Act, if you have to see this as a goods, then obviously it is for making payment for the product, number one. The second debate which has now crept in, which is also finds place in some form in MTech, is that the 2012 amendment which happened, which is the amendment budget as we call, is that one of the things which happened was that they introduced retrospectively the definition of the royalty of 916. Now the question here is whether those transactions or the resellers who had made payment to the OEMs had happened before 2012, whether the treaty will prevail or those amended retrospective domestic tax law will prevail. And I think here also the high courts have been very consistent, and they have said very clearly, saying regardless of your change in the domestic tax law position retrospectively, as long as there is a treaty exists, then the treaty shall prevail. The only situation is that if the government is of the view saying that similar analogy has to be taken for the DTA, then the contracting states have to renegotiate and amend the definition of royalty. I think on this point, there is a recent judgment, which is not on software, but again, as one of the subject matter of 916 on process, New Sky Satellite.
Okay.
And it's a very good observation by the court. They said the act of the retrospective amendment being used as a tool for interpretation of the expression used in the treaty is illegal. They have gone a bit.
Have they used that kind of a hard language?
Yeah, they have gone that language. And they said that yes, if the effect were to be given for the same language, then it is better that you go and renegotiate both the contracting sides, and then probably you can make this use of the interpretation. So I think, all I'm just saying is, apart from the main issue being pending in the Supreme Court on the subject, there's a secondary issue which has come because of the amendment, whether the interpretation of the royalty as the amended definition should prevail over the DTA or not. And it becomes much more sharper in those situations where there is no treaty. I mean, it's a
then only the domestic law.
Then only the domestic tax law. Then what happens to it?
Yeah.
And of course, in the New Sky satellite, there was an observation. I mean, they have not actually categorically mentioned what will happen in that situation. So that is still left open in that situation.
So should we wait for Supreme Court for the final word, or do you see some resolution happening?
Well, look, I think as Ganesh mentioned, it depends upon whether you're fighting on domestic law,
right,
tax law, or on the treaty. Yeah. So on the treaty, that look, I mean, ideally you should not be overriding a treaty. The Indian Constitution also doesn't generally give you the power of overriding a treaty. I'll come to it whether you can override or not override. So far as the issue of software is concerned, where they look, the amendment, the retrospective amendment had taken place in the domestic law. Now under the treaty, the way it is, the use of software, and the international jurisprudence, the OECD guidelines, even some of these decisions, earlier decisions of the Indian courts have been that there has to be a distinction between user of a copyrighted article versus the user of a copyright per se.
Right.
So Ganesh talked about resellers. You can also talk about the end users, you know, maybe manufacturers who are importing very sophisticated software for their own manufacturing process. Here you're buying, or let's say you're using a license of a copyrighted product and not getting the copyright
as an end consumer.
Yeah, as an end consumer. So there also it should not be a royalty as properly understood in the parlance of international tax treaties. Now, when India makes the retrospective amendment in the domestic tax law, the better argument, the better view is it should not impact the tax treaty, unless you say that even, you know, the treaty generally has a provision that undefined, provisions were taken further from the domestic laws.
Right.
Now, the limit to what undefined, provision would be,
and at what time do you define it?
Absolutely. So, you cannot just define it after 20 years after the treaty was negotiated to say this was the understanding at the time the treaty was negotiated. That's not right. So, by retrospectively amending 916, and Ganesh talked about etc. There they made an amendment in section 90 to override 90 itself to say that as per the
differential tax rate will not lead to discrimination.
Tax rate will not lead to discrimination by overriding 90. In these 916, 917s, etc., they haven't overridden 90.
Right.
So if you're covered by the treaty, I think you should continue to be covered by the treaty, and you should be getting the favorable ruling. Intersoft, I think, very correctly distinguished and differed from the ruling of the Karnataka High Court in the case of Samsung, etc. In our very humble view, I think that's a better view. But of course, all these cases, as Ganesh mentioned, have gone up and lying disposal before the Supreme Court. And we only hope the Supreme Court takes a rational view and the favorable view, as Supreme Court has so often in the past, including Vodafone's, etc., have taken, I would say, more rational views in deciding international tax disputes.
So we'll wait and watch. Since we are rushed for time, we have time for taking one more case. So I will stick with the goods definition, and this time we are talking about advertising inventory. And the case I have is NGC Network Asia LLC, and where the whole principal-agent relationship has been brought to question. And whether advertising inventory can at all be considered goods and bought and sold on a principal-to-principal basis. So Rahul, I believe you have studied this case in great detail. I've read your article also on that. So why don't I have a quick snapshot from you on that?
So you see here, the tribunal held that even when you have, and these are all with respect to channels, television channels, that when you're having advertisement inventory as in a principal-to-principal format or principal-to-principal structure, the tribunal said, in a sense, it's principal to agency, P2A rather, because you cannot buy and sell advertisement slots, if you would like to say. Now, I respectfully differ, because what you're actually selling is not a tangible product like a glass or a pot or whatever it is. What you're selling is a right to receive service. So in services, right to receive service is tantamounting to distribution under principle to principle. And going by experience, we have seen that advertisement slots are also perishable. For instance, if you buy, let's say 100 hours of advertisement slots for distribution, and for some reason, if you're not able to get customers for or advertisement for those 100 hours, those are perished, and you bear the loss. So the distributors do bear the loss of, let's say, perishable advertisement slots. So the fulcrum or the starting point of debate to say that the distribution of advertisement slots cannot be on a P2P, in once again a very humble view, is not right. Secondly, when the tribunal goes to say that it should be a P2A, that means you're talking about an agency P. Next point is, what are you going to gain out of it? Because when you have a P, what's the whole objective? The objective is to tax the delta between the distributor's profit margin and the profit of an agency. Now, when you are already working a P2P and getting a distribution margin, which is subject to review by transfer pricing, now you're not going to get a single farthing by saying it's a PE, and therefore can I get something more? So even otherwise, the theoretical PE would be of no use, because the transaction and the arrangement in substance and form is that of a distributor.
So the whole Morgan Stanley debate, it comes back that, can you ascribe something more beyond?
I would say it is something, you may leave the Morgan Stanley aside, because here actually you're operating as a P2P distributor,
full risk bearing distributor.
So the whole concept of an agency P is to see that whether by working as an agent you had, in substance or essence, you worked as a distributor, and therefore you should have got that extra more,
higher profit.
But if you have already got that extra more, which is nothing but distribution margin through your transfer pricing, then what would you gain by asserting a P?
So it's a zero-sum game.
It's a zero-sum game.
So do you agree with that, Ganesh?
Yes, I agree entirely with Rahul, and I think they have still tried to equate two things. One, they have equated these services to goods, and I think there was some observation in the tribunal judgment which says that in goods you consume, and how will you consume in case these advertising slots are not sold or there is no broadcast which happens? I don't think so. In e-commerce situations, one can choose straight away and simplicity equate like this, and that's how the whole challenge comes in terms of taxation of e-commerce. The second and most important thing, which is a bit worrisome, which is that on one side, if you look, it looks that they have disregarded the principal-to-principal arrangement and gone for the principal to agent on the grounds of two. One, that the substance is still an agency. Two, in form it may be principal-to-principal because there was a change in agreement in this case. The second most important thing is that the method of and mode of computation, if there undergoes a change, that does not change the substance of the transaction. Because earlier these people were getting as agent commission, now they are getting advance and they are retaining, and whatever ad spend comes, they retain and all. And here I would like to draw one reference on the BEPS action items on the permit establishment. And where the BEPS recommendation essentially is that the lower threshold of somewhere sidestepping their fee in certain jurisdiction, and one of the examples which they have given is the commissioner structure in a distribution scenario. So that is more in terms of a hardcore manufacturing scenario where a brick and mortar company, the distribution happens. But somewhere if you are to drag that here, and tomorrow as and when the case travels further, one of the argument probably revenue will also try to say is that if this is the commission structure, then how does it sort of escape the P? But I think even if it is established P, I think I agree with Rahul that what is that additional you are going to get unless you are able to demonstrate that the transaction P2P or as alleged by the revenue as P2A still falls short of the arm's length, the distribution margin which is not left. Otherwise, then it's a theoretical P which you are trying to create.
So, for argument's sake, maybe I would, just because a non-resident is taxed at a higher rate, maybe I'll get a higher tax if I tax.
Now, that's, I would say, and that's what the vexed question is all about. And that is where, you would like to maybe borrow Morgan Stanley.
Yeah.
Where the essence of Morgan Stanley was that, look, so long that particular amount of profit which you are trying to ascribe to the P.
Right.
if it has been taxed in India, then there is no gain in trying.
No further inquiry.
No further inquiry is required.
Right.
Now, there the Supreme Court, I think, took a more economic macro view rather than going to the micro issues of differential tax rate.
Right.
Because look, we are not aware of what the facts of Morgan Stanley were in those days. Those years, it could be about 10, 11 years back.
Yeah.
It could have been covered by STP, it could have been covered by SEZs, etc., where the entire profit could have been exempt also. So instead of a 30% versus 40%, it could have been a 40 versus 0.
Right.
But the Supreme Court, again, I am saying it was a very positive outlook. They were looking from a macro standpoint that if the money is just coming from a right pocket to the left pocket in the same country, then don't go for it. It's a theoretical exercise.
So there's no base erosion. So
there's no base erosion. There's no base erosion.
There's no base erosion.
And that extra 10%, I personally feel that revenue would be better off to channelize the energy elsewhere rather than on the differential 10%.
Maybe on the black money.
It's a vexed question, but that is where I would fall back on Supreme Court to say that don't have a theoretical exercise.
No, I fully agree with you, and since we are up for time, I would take leave and thank you, Ganesh, once more for coming and sharing your thoughts, and Rahul. Thank you once again.
Thank you very much. I mean,
it
was really a pleasure to share the podium along with Ganesh. Thank you.
And subject to your busyness or availability, we'll again request you to come here maybe after the budget and share your views on or your prognosis on what has actually transpired in that document. Thank you again. Thank you, Ganesh. Thank you, viewers, for your patient listening. Have a very good weekend and a very nice day.